Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is a friend of mine. I talk to him a lot about markets. He is one of the best analysts under 30 years old. He was formerly a research analyst at Agora Financial, also the macro analyst and chief editor at Palisade Global Investment. Currently, he's the editor at Speculators Anonymous. He specializes in options trading, but also really good global macro research. Adem Tumerkan, thank you for joining me.
Oh, thanks, Jason. I really appreciate it. It's always a pleasure.
So, Adem, the last time you were on for a podcast interview was in, I think, early to mid 2019, and we were going over the global macro analysis, and you were talking to me about one of the leading economic indicators you follow, which is some South Korean export data and how bad it was getting, and then we were discussing problems with German exports. So we saw that the global economy, coronavirus or not, was getting a lot worse in 2019. A lot of it had to do with how much the Chinese economy was slowing down and then South Korea and Germany exporting to them. So do you think that the global economy, are there any signs it's improving, or is the global economy, the global macro, still in a really bad spot?
So I personally believe that it's still in a really bad spot. We were in a cyclical downturn. The Fed was over-tightening. They raised the market rate of interest higher than the natural rate of interest, in my opinion, going off of Newt Wicksell, famous old economist, Wickselian differential, which basically says that the economy has its natural rate of interest even without the Fed. Like markets price in interest, it'll have growth even without a Fed. But when you have a Fed come in and manipulate rates higher, like when they can raise short-term rates higher than the natural rate of interest, what the economy justifies, it starts constricting growth. And when you lower the market rate below the natural rate of interest, so if it goes from market rates go from 3% to 2% and the natural rate of interest is 3%, it'll expand growth. In my opinion, in 2018, they were over-tightening, and it led to a 2019 earnings recession and trade recession. And I think the big thing a lot of people aren't following, they're so hyped up on maybe U.S. growth or macro data. But remember, the U.S. economy since 2008 isn't the global growth engine. And you and I have talked about this before. China is the global marginal growth engine in the world. That's where that extra growth will come from to carry the world. No one else is getting, that big of a scale, 6 to 8%, alleged growth per annum. And I was reading a recent IMF report, 49% of global growth post-2008 came from China alone. And, you and I both know all the commodities from Australia and all the cars, like all the new markets that, iPhones, for example, it's all in China. Like that's where their growth estimates are coming from. Well, the big thing here is that China, since 2016 and 17, you and I talked about this, one of our last interviews, was that President Xi was under pressure to rein in the shadow banking industry. So we're trying to tighten without, over tightening too much that it would be too much of a drag on their economy, but not enough that it would, not as much. More or less, they wanted to restrict leverage growth from being like bubble levels, which China they had a debt problem. And since 2016, if you look at the aggregate credit of that China has an index, it's like the aggregate financing, pretty much their liquidity, it's been like steadily going down. And it just shows that even in this recession, right now, China's actually been letting some bonds mature. Like that's actually tightening because they're not rolling them over. So it's actually reining in the liquidity in some of the Chinese banks, the bigger banks. But the Chinese government is subsidizing the smaller banks. So they're kind of trying to do like a big crony socialist scheme right now. But the main takeaway here is that they're not easing. And you and I had spoken about this in last time, is that China in the last three cyclical downturns, 2008, 2012, 2015, China, remember they devalued the yuan and they did big social spending. They did big binging on debt. And a good way to look at this is if you look at the year-over-year growth in China M1, that's a liquid money supply. If you look at the year-over-year China M1, you would see that that is a great leading indicator for Chinese demand. because that shows when people are going out into business or having more cash on hand, and they're also the consumers in China are buying more, money circulating faster. Right now it's dead for this cyclical. It's still, like, I was just looking at the year over year, it hit 0% growth last in January. Now it's at 5%. If you look at a historical perspective, it's lagging every other cycle right now, like significantly, which tells us China isn't easing. They're not expanding. And a lot of people think it's because they want to take better care of their fundamental economy in the long run, or, you know, they're preparing for a trade war with China, whatever the reason may be. It's probably a little bit of everything. But the main takeaway here is that China isn't over easing, which isn't going to drive marginal growth, which means I just don't see how the world is going to get that growth spurt.
I think China has a very serious stagflation problem. There's much higher reports of much higher food prices, especially for pork, other meat, vegetables. And then there's a lot of video protests of people protesting rent increases at shop owners in malls, shop owners at stores for commercial property. So, you know, when you combine those two things and the fact that a lot of Chinese manufacturers, the orders are not there to export yet. And I've seen reports, I've read articles where some orders are down 70%. This is not a good recipe for the Chinese economy to rebound very quickly. And if they do inject lots more credit, like you said, lots more quantitative easing, there might be a lot less goods and services and a lot more currency chasing that. That could be very, very inflationary. So I think that's why they're holding off right now. They're worried that it would be too much inflation into the real economy, and the economy has not really recovered that much because there's not as much demand to export yet.
Yeah, exactly. Yeah, I totally agree with you. It's just, I mean, if you look at so China, yeah, they do have a stagflation on the consumer side, but if you look at their industrial side, they're having deflation. They're having year-over-year price drops. So China, since they're such a large exporter, they're exporting that deflation, which is pushing prices worldwide down. So I just don't see how, you know, especially with the Fed in September, the Fed is going to start launching their, probably around September, their interest rate manipulation. What is it? They're going to start
yield
targeting
curve control.
Interest rate. Yeah, exactly. Yeah, right. Yield curve control, maintenance, or whatever. Yeah, and I think that's what they're going to do to keep interest rates low artificially, to try to get inflation going. I think they're going to be worried about a deflation problem over the next couple of years, and I think that's what, you know, they have to think outside the box. Even though I don't think that will work. It hasn't worked for Japan. I think Australia is the only other country that's engaged in that, and it hasn't really worked for them either. So I don't see why it would work here. But pretty much everything Japan and the European Union have done with their monetary policies is pretty much what we're going to see the U.S. do, I'd imagine.
I don't think everyone can do Japanification at the same time without making things a lot worse.
Yeah, that's exactly. So it goes back to that part about who's the marginal growth engine. Like, you can't have everybody going through Japanification. And China has, I mean, if you look at the similarities between Japan's explosive growth in the 70s and 80s and crash in the 90s, especially demographically, very similar to China today. Like, China has a record number of people leaving their workforce over the coming years. And due to years of the one-child policy, this is like the generational problem it's created. So it's not a marginal fix. But the problem worldwide is I just don't see. Investors always need to ask themselves, everything is driven by the margin. Like, on the day-to-day, like, for instance, the coronavirus, on the day-to-day, hospitals had enough to take care of, you know, sick people, the everyday sick people. You know, grocery stores had enough toilet paper for everybody. But then all of a sudden, you have extra, demand come in and over the margin, and it's all of a sudden hospitals are filled up. All of a sudden toilet paper is gone, and it's not coming back for weeks. So everything's always driven by the margin, and that includes economic growth, in my opinion, and asset prices, everything. So when you have a little bit more sellers than usual compared to buyers, prices collapse. And right now you have too many global economies. I mean, it's not just like America's GDP is negative 30% expected in Q2. This is a worldwide problem. I mean, in my opinion, markets are now forecasting growth from 2024. You and I have talked about this before. It just seems like at this point, investors, they don't even, and an analyst, they don't even price in data, like current data anymore. They're just pricing in 4 years data, 5 years, 6 years. It's like, it seems like they're going out further and further into the future at this point to just fit what feels right to them to justify being long.
Or it's like what Stanley Druckenmiller says, it's just about the liquidity flows. Everyone's betting on what the central banks are going to do.
That's absolutely true too. And Stanley Druckenmiller is a god among investors, and someone I look up to, and I think he's dead right on, you know, what he says with liquidity. Liquidity controls asset prices. And right now you're seeing a massive amount of liquidity come in because of the Fed. I think their balance sheet year over year is up, 3.4 trillion. And it's not going to slow down. They've been trying to say they're scaling back, but my thing is that this is creating the dollar shortage going to be worse. So we've seen I guess, let me touch base on that. The US dollar has been recently falling. I think it's down 5% over it's down significantly from its March highs. And, you know, a lot of people are thinking because of all the credit lines that the Fed's done and all the pumping of the trillions and liquidity and everything. The thing is, the demand for dollars is much greater than what the Fed has printed. Like, the US will probably run larger deficits over the remainder of the year. So with them increasing the money supply 3 trillion, and I think the Treasury alone ran a record fiscal deficit of, 2.5? No, I think it was 3.1 trillion. I forget, it's somewhere in between that number, but that already sucked up all those new dollars. Those had to go to the US government to send out in stimulus checks, which the people aren't spending. So we've seen savings rate private savings hit record high, while income, increases. But at the same time, on the opposite side, retail sales have collapsed. And with the US economy being a consumption-driven economy, people aren't spending. So I guess that's the idea, that pent-up demand. People believe these consumers with all this cash are going to go out and spend it. I don't know. Time will tell. But I don't see what that will really do much different than how the world economy was already in a cyclical downturn before Corona.
A couple thoughts there. So the Fed says it's slowing down their asset purchases and the balance sheet growth. They went from increasing the balance sheet about $300 billion per week to, I think it's about between 60 and 70 billion per week. So it's still growing quite a bit. I mean, it's just not at the crazy levels it was in end of February and March.
Yeah, they're expanding it. But I think from what I last saw, it's mainly through mortgage-backed securities at this point. That's been the main thing, through the mortgage-backed securities, which that they've been, and also extending the credit through credit lines to other countries. But they got to be repaid. A lot of the same with the overnight repo market intervention they're doing. They got to, which is where most of the liquidity has been coming from. They got to repay those loans. So I think that's a lot where the people believe the dollar probably has more room to run in the future as the dollar, as all those dollars get sent back to the Fed. It's going to come back to being tightening. So we'll have to see if they expand it. But I think that the Treasury at this point is going to be has to borrow more money, especially if they do another little stimulus. They're going to have to borrow more money through deficits, helped by the Fed. It's not a surprise that the Treasury ran a $3 trillion deficit spending the same time that the Fed began easing, multiple 3-4 trillion.
Well, they're switching to MMT Lite, or a version of MMT now. So they're trying to increase, like you said, consumer spending.
Yeah, that's what we'll have to see if that'll really carry, I guess, global growth. But again, I don't really see that. I mean, if things even go back to just how they were before Corona, the marginal growth problem still depends on China. And I think a lot of people are obviously at this point, U.S. stock prices don't even reflect reality. They're pricing in a future at this point, and that is going to be very optimistic, like the V-shaped recovery we keep hearing about. But we're still looking at near record unemployment, and retail sales down, what was it, like negative 16% or something last quarter or last month. These are huge numbers, and it's not just in the U.S. like we were talking about before. This is all over the world. I mean, we're seeing massive record declines in manufacturing. And I just think, years of overcapacity, overproduction, betting on future growth, and plus now the loss of demand is creating, a big deflation problem on the producing side. And I don't know how these firms are going to do it, because historically the last 4 big bear markets, in a great book by Russell Napier called The Anatomy of a Bear, talks that the one thing the major bear markets all had in common was that deflation preceded them. And I think if deflation continues, or if prices keep going lower, that'll affect corporate balance sheets significantly. And we'll have to see if the Fed will have to step in. But, like we know, the Fed can't print demand. They can give people all the money, but if they don't go out and spend it, like what we're seeing today, they're not actually spending the money. All those $1,200 stimulus checks, people are keeping them right now. So we'll have to see if they go out and spend them, but so far they're not.
We're recording this interview on Friday, June 5th, 2020. You talked about deflation there, but what worries me is all this currency and credit, all these central banks and fiscal policy stimulus spending from these governments, that it's going to create so much misallocation of capital, so much malinvestment in the global supply chain. And the global supply chain is not functioning normally. Everyone's seen on the news the problems with the food global supply chain in the US. I think these distortions, Adam, and if factories leave China over the next, 2 years, 5 years, 10 years, that's going to mean higher cost manufacturing in other countries. These are all going to force costs up in the global supply chain. So do you think that that's going to be stagflationary at some point, that we're going to have a lot worse stagflation?
Yeah, we definitely could. I normally don't like guessing on these things or estimating, just because I have no idea. A lot brighter economists than me have no idea, and they've been dead wrong for years. So I think at this point, I think to really understand inflation, there's 3 types of inflation. There's demand pull inflation, which is when you more demand than the supply. So usually demand pull inflation used to be the main inflation in the mid ages. When there was bad spouts of inflation, it was because during periods of calm, people were having more children. There weren't as many wars, so you had a longer lifespan. Plus, you had more children. Men didn't have to go off to war; they could have more kids and whatever. So you had prices were ticking up. There's actually a great book about it. It's one of my. If anyone wants to understand inflation throughout history, I definitely recommend the book "The Great Wave: Price Revolutions Throughout History" by something Hackett Fisher. He's a great historian, but that is such a great book on the last millennia of inflation. And the core thesis was that there was 3 types of inflation: demand pull, which is, like I just said, the prices from being more demand, more people wanting XYZ goods compared to being produced. And then the second one is cost push, which is, let's say the price of oil, supply of oil declines, and the price of oil goes up 50%, then you see the price of gasoline, go higher. So that's the supply side. That's cost push. And then you have the monetary inflation, which is the easing, the Fed easing. Back in the day, they used to think, prices are going higher, like in the 1180, when they were having these inflation. That's why Christopher Columbus and them in the 1400, 1500, whenever he came, that was because they were looking for silver, because they thought, prices are going higher. People need more money to buy these new things. Let's add silver into the system. So they'd melt down swords, or they'd have to go find new silver. But later they found out that was actually making the inflation much worse. So the 3 types of inflation right now we're seeing on the cost side, there's just been massive oversupply, like in oil everywhere. I think that's pushing prices down. There's just been too many commodities overproduced on the assumption China was going to be growing higher in the future. Then on the demand side, we're having a demographic problem worldwide. I think that's we're seeing that in Europe right now, in Japan. So that's definitely going to be a factor we got to take into account. And then so that leaves us, both sides are deflationary on that side, and technology, everything improving, pushing prices down. But then, like you were saying, yes, we have central banks printing like mad right now. So I guess it just comes out if the one inflationary side, the monetary inflation, can overwhelm the 2 deflationary sides. I personally think inflation is a behavioral economic topic, because throughout the big bouts of inflation throughout history, it's usually come when people realize prices are going higher and producers start raising their prices because they think of the extra demand from the hidden inflation tax, which leads to spiraling higher prices. But until we see that, I don't really think there's going to be much inflation, like, significant. But I do think in China right now, because we're having, like, the meat prices we're seeing, that's mainly because of cost push, because of the decline in pork and everything, and you're having rising income, people wanting to buy more, meat prices, whatever, from, rising income. So we're seeing more inflationary pressures from the demand pull and cost push side in China. So I think we're going to see stagflation there for a while. America, Eurozone, Japan, I don't know. That's just my opinion on everything. But I guess we'll have to see if the central banks can do enough fiscal stimulus to, now at that point, that's different. If the fiscal stimulus steps in, that's where the government, finances, like the Fed prints the money, the Treasury borrows it, free of cost, whatever. The Fed prints the money to buy the bonds from the government. Then the government gives it to people, like more $1,200 checks. So let's say they do $1,200 every month. Well, that would increase the inflation, because that would increase the demand push of it, because now people have extra money to go spend. And I guess we would have to see at that point if that would push prices much higher. But I don't think the Fed's going to want to do that, because I think they know that would be really inflationary. Like, they don't want to get that much inflation.
It could get out of control. It could get out of control very quickly.
Exactly. So I think that's why the Fed's been very mute on that front. And right now they did it because of the loss of demand. So they didn't mind giving people $1,200. But remember, Trump was saying, "Oh, think big." Like, they were thinking about doing, why don't we just do a $10,000 payment for every family? Like, let's think outside of the box. And the Fed, and that idea didn't go anywhere. That would have been extremely costly. And now they're thinking about doing student debt. So now I guess the other side is, now there's too much debt in the system. Historically, when you have this much debt, it's hard to get inflation, because so much money has to go back to paying down the debt that it takes away from other demand. And it pulls money out of the system, because when you repay a loan at a bank, it cancels the debt. The fractional reserve system, we'll go into that another time, but how that works. When you pay debt down, it, erases the extra money in the economy. So if the Fed starts doing, like, big debt clearing, like on the millennials and everybody with student debt hit like 1.8 trillion recently, if they start doing like debt forgiveness plans, or like we were saying on the auto loan bubble that's out of control, if they do cash for clunkers, well, that's if they start doing those things, well, then I think at the demand side, at the margin, that would tip inflation higher than we're used to seeing.
Yeah, either way, there's a lot of distortions in the system. So it's going to be a nightmare for most people, because some prices could go down, some prices could go up, and people are going to, the average person on Main Street listening to this podcast who's not a financial professional like you or me, is going to be left scratching their heads. Well, unless they listen to my podcast or read your articles.
Right. Yeah. Yeah. No, it's a scary time. Like, it's, because nobody really knows. Anything can happen, like COVID. A big thing we've always talked about, a big core belief of mine has just been like how the blocked swans only show, they show themselves where people least expect it. And, COVID just hit out of nowhere. Like, if you look at all the estimates for 2019, like recession probability, they were all like going down at the end of the year. And I was reading like a Goldman Sachs thing. It was like the chance of a recession in 2020, it was like 5%, and then all of a sudden, well, what do you know? It's a global recession hits out of nowhere. And, it's just, things can happen, and just, they can make big, everlasting changes on the economy.
Well, you and me were warning about global recession because we were looking at the global macro indicators with China and the export data from leading export countries like South Korea and Germany. So that had not affected the US's economy that much, but people like Goldman Sachs, more mainstream people, were just ignoring a lot of the global macro data and the research that they were writing and saying, oh, the US, I think their assumption was basically that the US economy was insulated from a lot of those other problems. But historically, it was, I think, similar more to 1927 to 29, because there was a lot of capital coming back into the US. The stock market was on fire through February. And then we had a big crash there right as the stock market was close to 30,000 Dow.
Exactly. Yeah, you hit it right. A lot of people treat macro like it's an objective topic. Well, macro is relative. It's in the U.S., like you said, was the prettiest mare in the slaughterhouse. Same with the U.S. dollar, meaning even if the dollar isn't great because of U.S. deficits and everything, and the U.S. economy, it's better than Europe and Japan and China and Australia and Canada and so forth. So the money parks itself into America, and that's what we had seen in 2019. But one thing I learned, which I think will become a big topic in economics study later, is it's a concept called systems thinking. The core two things in systems thinking is feedback loops. You have amplifying feedback loops when things spiral out of control, or you have reductive, subtractive feedback loops when things pretty much when things like settle down, take away from it. So amplifying goes up, and then subtractive goes down. So there's the feedback loops, which, things amplify on top of each other. And then you have on the other side, lag effects. There's a time lag. So, when a macro data comes out or we see like slowing exports in South Korea, that's not going to affect markets probably for 6 months. So like same thing we've talked about before. By the time we see GDP in recession, that we're looking 6 months into the past at this point. So I think people, when they look at these that's why I think leading indicators are so important compared to lagging indicators. Like unemployment is a lagging indicator, because by the time layoffs start happening, it's too late to make your positioning, I guess in my opinion. So I think the US economy in 2019, we saw the global recession happening and the US was on its way being affected, and then COVID came and just amplified the feedback loop much worse.
Yep, I agree. Yeah, I think the global depression was already happening with outside the US, and then it came to the US last.
Yeah, the Fed, in my opinion, I think the one thing the Austrians did well was the Austrian business cycle theory, with Mises' idea of like how the central banks can cause malinvestment and distortion and moral hazard in markets through printing. And, a decade of zero interest rates created a massive bubble. Then the Fed, ignorant of the Austrian business cycle, started raising interest rates, and it created a global dollar shortage and pretty much ruined every other economy besides America, which, because of the amplifying feedback of a globalized world, would eventually have affected America, which is what we were seeing at the beginning of 2020. So yeah, I agree. I mean, it was happening one way or another.
Yeah,
not this significantly, but it was definitely, on its way.
A last global macro topic before we move on to your options methodology with like Mark Spiztnagel, Taleb, and then the new top hedge fund manager, Diego Padilla, is emerging markets. So you talked about the dollar shortage. I think the problem is that the dollar shortage is exposing bad business models in the emerging markets the most. So over the last 15, 20 years, emerging markets set up a lot of their businesses to export either luxury goods or raw commodities to China. And then really over the last, since 2011, especially after the 2008-2009 financial crisis, when everyone saw Ben Bernanke doing what the Fed was doing with the quantitative easing programs, everyone expected this weak dollar trend to continue. So people then borrowed in dollars, and then they were exporting to China. And now, with the Chinese economy slowing, commodities demand are down. Now emerging markets are the ones that are left holding the bag because they have so many bearish headwinds at this point, and they are the ones that are getting killed the most with the dollar shortage.
Yeah, absolutely. The dollar shortage, it's like what Nixon said back in the 70s. He was like, the dollar, it's not our problem, it's your problem. Because, we print the dollar. We're the sole creator of the US dollar. So we can print it and, fund our own deficits if we need to. But China and all these other countries, like you were just saying, both governments and corporations have had a record number of US dollar debt. But they can't print dollars. Look at Argentina. They don't have access to dollars unless the IMF or the US gives it to them. So yeah, that's a big problem. You have a huge amount of debt. I think over 10 trillion in just corporate debt alone, $10 trillion denominated debt maturing over the next 4 years. And I think 1.5 trillion of that is from companies already junk rated. The other 10 trillion is on firms near junk. They're at BBB rated. BBB rated is the last notch on investment grade. So if these firms, I just wrote an article about this actually, there's also a record 111 firms that are labeled potential fallen angels. A fallen angel is a firm that loses its investment grade status, like Ford recently. I'm sure you saw Ford was downgraded from investment grade. It got downgraded to junk, speculative rating. There's a record 111 firms in the U.S. that are at the edge right now with a negative outlook to getting downgraded. And if they get downgraded, these firms, especially worldwide firms that need dollars, that's why the credit swap lines were so important. The Fed gave swap lines to European Union. Interestingly, they didn't give any swap lines to China. To the best of my knowledge, China hasn't gotten any of these swap lines, which is interesting. It was mainly Japan was a big user of them, the European Union as well. So we gave them those dollar swap lines. Then those banks in Europe had access to those dollars, which they could give to their companies that need these dollars. So, we're seeing a big starvation worldwide of dollars, and I don't see it going away anytime soon. That's why in the short run, this easing and everything and probably expecting demand to come back might be inflationary, which was what we're seeing in the market, which is why the dollar's been under pressure recently. But I think the long-term fundamentals for the dollar are still much higher, just because there's so much debt worldwide and there's so much demand for dollars, especially as all this maturing debt needs to either be paid back, which you and I both know these foreign firms that borrowed in dollars don't have that money on hand most likely. So they have to roll that debt over and get new dollars to repay the old dollars, basically refinance. And if something like a COVID or a world recession happens and earnings are down, these firms will have look what happened in March. Like the Fed is now actually buying junk bonds. They're actually buying corporate bonds and junk bonds starting in the beginning of May. And even though it's not a significant amount, they did it because they had to restore confidence to the credit markets. And you and I have gone on forever about the oil bubble and how a lot of these junk rated firms are U.S. fracking companies, shale oil. And at this price of oil, I don't see how that's going to, the point of, I get us all about all this is that, yes, the US dollar shortage is probably going to be around plaguing the world economy for much longer.
And also the dollar tug of war. So this is going to go back and forth. And if the dollar gets too strong, you're going to see President Trump, the Treasury, the White House, Congress talk about spending more. So to try to weaken the dollar. I think they're aware of the dollar shortage problem now. I don't think they were aware of it for a while, but I think they've been well aware of it now for at least like the last couple months.
Yeah, I agree.
And that's why you have crazy ideas in Congress about sending out $2,000 per person per month checks.
Yeah, that's all for, obviously we've talked about before, to get votes. And these people like AOC and everything, they're not, I think she has an economics degree, but she doesn't understand. Economics is a very subjective science. A lot of these ideas worked once and then they don't work ever again. Or what worked in the 70s, like the Phillips curve, the Keynesian Phillips curve. Now it has no relation to anything. That fell on its face in the 70s and created stagflation. So, I think a lot of these policies that a lot of these congressmen and politicians are aiming for are simply just to get votes and for short-term thinking.
So let's transition now away from the global macro to your investing and trading methodology using options for higher returns, for hedging, for volatility strategies. So you have done past interviews with me talking about your option strategy in more detail. It's based on Nassim Taleb and also Mark Spiztnagel, who founded his hedge fund in 2007 called Universa. And he had a crazy amount of returns during the stock market crash that we had at the end of February and March. In March alone, his options trading strategy produced 3,612% returns. The fund soared more than 4,000% through the first quarter. Just insane results.
Yeah, no, it was amazing. Yeah. Mark Spitznagel's fund and Mark Spitznagel's work has been heavily influential to myself. As a contrarian and investor, I was always interested in volatility. And there's a term called the volatility tax, thanks to Mark Spitznagel, whereas most people, they'll make those slow, steady gains for about 5 to 10 years. They'll make 5-10% per annum after tax. And then all of a sudden you have a 2001 a 2008, a 2015, a 2020, where you see a 30 to 50% drop in your portfolio. And then all of a sudden, now you have to, when you see a 50% drop, you have to go back up 100% just to get back to break even. So Mark Spiztnagel published papers on his website. You can read at Universa under the risk mitigation tab. He published papers showing that historically the biggest damage to a portfolio on a compounded annual growth rate metric has been from the volatility tax. It hasn't been someone, underperforming for a year or two. It's been these sudden, large, rare black swan events, negative, known as left tail risks, that come and just knock your portfolio, and completely ruin you. It's not like, it's not like a slow bleed. It's just suddenly, everything looks good. And the next thing you know, your portfolio is down 50%.
Yeah, and Christopher Cole has similar research out on his Dragon portfolio where he backtests 100 years. And he said that about 20%, the interview is available for free, I think now on the Real Vision TV YouTube channel with Daniel DiMartino Booth. It's a 2-part interview. The second part's, I think, the Dragon portfolio. And he says about 20% of people's portfolio should be in like defensive and volatility and hedging strategies where they have a certain amount of gold and gold stock exposure and then also options and volatility protection strategies. And he said backtesting this over a 100-year period helps protect against that risk that you were just highlighting there that Mark Spiztnagel has been writing about.
Yeah, definitely. So I think we always see these funds that are short volatility, which to me is insane. That's literally picking up quarters in front of a steamroller. You sell same with selling options, naked options. So that's what I like to call negatively asymmetric. It means you have a high risk with low return. And you make a little amount of money frequently. It's not every day you have a big black swan event. Most of the time markets are calm. And that's the worst thing for investors, though, because behavior goes off of the recency bias. All these things, the thing is how I've been able to come up with my trading strategy. It's been a lot of behavioral finance, a lot of Nassim Taleb, Mark Spiztnagel, which, Nassim Taleb's work, anti-fragile, isn't even investing. It's like philosophical. But it's so important because you can take these ideas and make them into your own. And I think that's like what the Artemis, Chris Cole at Artemis came up with, actually took these kind of concept and was able to make it into something great. And he even made his own back-tested model. And Mark Spiztnagel, who's a protege of Nassim Taleb, he made 4,000 returns in 1 quarter. And on an annual basis, so I would rather lose money, a small amount of money frequently with very limited downside, with the chance of making 10 to 20x returns infrequently, than make money often, small amounts of money often, but the chance of blowing up infrequently, if that makes sense. So I have a very high chance of imploding my portfolio rarely, but I like to turn that model on its head. That's how most modern portfolio theory is done. It's done with, you buy things, you want that slow, steady gain. And but the thing is, a lot of like Chris Cole did with that paper, he proved that a lot of the modern portfolio theorists, they say, and Mandelbrot, Benoit Mandelbrot actually, who was like a mentor to Taleb and Spiztnagel, his work showed that a lot of modern portfolio theory shows that big, Dow drops or spikes in volatility are super rare. But like Chris Cole showed on that paper, and Benoit Mandelbrot before him in the 90s showed it's actually not as rare as the market prices in. So that's how money's made. It's like, yes, the chance of a black swan happening is rare, but it's not nearly as rare as what the market's pricing in.
Well, they happen every 7 to 10 years now because of all the central bank intervention, because they're creating all these credit bubbles and then and asset bubbles, and eventually one of them blows up. And then they have to find, and then they have to go and either reflate an existing bubble or find a new bubble, a new credit bubble or asset bubble to inflate.
Yeah, exactly. And then, so that's what Mark Spiztnagel would like to call like a gray swan, was that you can actually look at, because of the Fed distortion in the markets, he's able to actually position himself to benefit from a correction. He doesn't know when it will happen. Like no one knows like timing on anything. I don't care how good anyone's algorithm or some trader is. you can never perfectly see the future. Imagine, for the listeners, think of where things were at the beginning of 2020 and imagine where things are today. Did anyone see this happening, playing out this way? Maybe you did, it was lucky, and I think a lot of investing comes down to good fortune and luck. A lot of my best trades are luck. But the thing is, I put myself in that position so that when I am lucky, I can make 10, 20x.
Well,
and if I'm not lucky.
Well, I just want to interject here. Luck is where preparation meets opportunity. I know how hard you work, man. You're under 30 years old and you're making a name for yourself in this industry. I've had to work a lot harder than a lot of people older than me to make a name for myself too. So it's your luck. You made your own luck. That's just what I'm saying.
True. Yeah. So thankfully I've had the tools to be able to, be luckier than most. But the main idea on, I guess what I was getting at is like a lot of these trades, like black swans, being able to forecast when, people always ask these investors, like, when will this happen? When will this happen? Like Peter Schiff with his gold thing, I think that's why he put himself in a box. He kept telling people, oh, gold in a year from now, or this will happen, gold will go up. And when you put timetables on things, it really discredits, because even if it does happen, can lightning strike twice? Can you do it again? And I think it becomes harder for your credibility, making these kind of big force, calls, especially if you don't see anything in the market. So what I would rather do is once a year when it's cheap enough, because like you and I have talked about, buying options is all about, this is the problem I've actually had all year, was I made a lot of money at the beginning of the year. And since that, fortunately, very luckily, and I've only had two plays in 2020. One was long uranium, which you and I can go into later. And then the other was a long future VIX put, because the VIX was so high. I was going off of my Minsky thing where low volatility creates high vol and high vol creates low vol. I was betting the high vol in the March would eventually settle in later in the year. So I bought long dated VIX puts. And the point of these are because it gives me enough margin of safety on the timing that I don't know when it'll happen. But if it does happen, I can capture that upside, like having insurance. A lot of people need to realize when they look at options, it's like insurance. You're paying a little bit of money on the premium. The most you can lose is the premium when you buy an option. That's why Taleb's work on optionality is so important, that you want to look for outcomes, not even just investing, but with anything, like starting your own business. If the upside significantly outweighs the downside, or if the downside is knowable, like, hey, the most I can lose here, craps table or whatever, is $500, no more, no less, you can actually quantify your risk there. But when you have these short vol traders and, all these hedge funds who come in and they make these nice fancy models, but all of a sudden they, if VIX does go the other way, and it could totally blow them up overnight. Like, remember long-term capital management in the 90s, or, their model showed what would happen should have never happened, the Russia default. And just because there wasn't a black swan somewhere before, like today, I think there's a black swan in the Hong Kong dollar. I mean, is it likely going to break? I don't know. Probably not. But if it does break, it's significantly discounted right now. The market is pricing that chance of it breaking in almost next to nothing, or it was at least last time I checked when I wrote about it last year in 2019. So it just, to me, everything is like on the margin until an event happens, then the prices go up on the things you buy, the options, or they don't go up, they expire worthless. So I think a lot of what I took from Taleb was, you just want to have a thick margin of safety. You want to buy portfolio insurance, like long VIX, like a long dated VIX call when it's dirt cheap, when volatility is at its lowest, because people don't expect it to go up. It's priced in like as a unlikelier outcome. And Taleb likes to call that actually anti-fragile. So when things are fragile, they break. Anti-fragile means you actually gain from turbulence. You gain from chaos. So being anti-fragile would have mean you actually position yourself that you made money in 2020 COVID, black swan, which Mark Spiztnagel did. He made a killing. And that 4,000% return he made was able to offset any other losses he had in his portfolio, because he does tail hedging. He'll go long, certain stocks and then buy long dated puts on some of those stocks so that there is a crash. The profits from the puts can offset the losses he took going long on that stock. So that's where I think it's important to have for portfolios to use is like a tail hedge strategy. Especially like just going long options, like once or twice a year, you can just like have a position you like. You don't know when it'll happen. Like that's like, did you want to just talk about the uranium thing now?
Let's wait to do that. I want to ask you about some of the books where you learned this. So Mark Spiztnagel, it sounds like he's running a real hedge fund, unlike people like Ray Dalio at Bridgewater and some of these other big players that weren't actually hedged, that were drastically over leveraged, that were using similar to the long-term capital management strategy. They were doing the over leveraged basis trade on corporate bonds and government bonds. They were doing the risk parity trading strategy, and those hedge funds all blew up, like you said, in February and March and had to be bailed out. The average person on Main Street doesn't know that.
Yeah, a lot of these funds blow up. A lot of these, like, especially short vol funds, like those really are like a dime a dozen. Then they get wiped out eventually. Like they work until they don't. Remember the vol crisis in 2018, February 2018? I think it was the opposite of the VIX, the XIV. It was like a short VIX thing. It like lost 90% of its value in a day, like the entire fund. I mean, it's those things like that. It's like, so 364 days a year, something won't happen. And boom, the one day out of 365, something happens. And all of a sudden, all your gains, everything you made is gone. A lot of these funds, they just close up shop and most of them will restart it. Victor Niederhofer, who he was a very famous investor in the 80s, 70s. Soros gave him his money. He was running a book for Soros, and I think he was averaging like 30% gains. There's actually a great paper. I recommend, if I can get you the link later, you could send it in the YouTube link later, but it's called Blowing Up. It's actually written by Malcolm Gladwell, the author of Tipping Points and Blindside and stuff. And he actually went and interviewed Nassim Taleb, working at his first fund, Empirica, with Mark Spiztnagel as his head trader. And it details how they made a killing in 1998, the volatility crisis with the Russian default and everything, the Asian contagion crisis, how their hedge fund soared in gains, whereas Victor Niederhofer, who was averaging 30% a year selling puts, betting on like low volatility, low alpha, he blew up overnight. He had to mortgage his house, everything he ever owned to pay back investors. Last year, we saw James Cordier do the same thing. So it's like you always see these investors, they make these steady gains, but they don't really tell you, or you don't really realize the chance of it blowing up or hitting the absorption barrier, which is an absorption barrier is a term meaning the point where you cannot go any further. Like if you go bankrupt, you don't have any more money, you don't have any more chips, you can't play anymore to make your own money back. So once you hit that absorption barrier, once you go bust, you're done. And a lot of these funds do get wiped out. And not only do they get knocked out, like James Cordier's investors learned, James Cordier's investors actually were in debt. They actually had to, not only did all their money get wiped out, but they had to pay the brokerage for his positions.
Yeah, that's crazy. That's similar to the people in China with the Bank of China shorting the oil, who were long oil futures, and then it went negative and all the other craziness that happened. James Cordier is the optionsellers.com. He was the guy shorting natural gas, right?
Yep. He made a bet against natural gas, and he blew up. Natural gas didn't go the way he thought, and it just wiped him out. I mean, and the thing is, it doesn't even, who knows why natural gas didn't work out? It could have been because of supply. It could have been because of, increased demand. Who knows? But the point is, he hedged himself in such a poor way that a situation that he didn't predict happened. And not only did it blow him up immediately, but it cost his investors. His investors got a bill from the brokerage saying, hey, not only is all your money gone, and he made a really cringy apology over YouTube he sent to his clients. And so I'm sure they felt their stomachs drop out. But adding salt to the wound, they got a bill from the brokerage saying, hey, you owe us hundreds of thousands of dollars on top of that.
Yeah, the same thing happened at the Bank of China to the people that were long their oil futures products when the oil futures contract the front month a couple months ago went negative. They had enormous bills that they owed to the Bank of China. The rumors from some of my hedge fund contacts are the Bank of China had absolutely enormous over-the-counter oil derivatives losses. One person told me might have been over 100 billion in losses. But the book that helped teach you a lot of this Are there a couple books? So the one book that I've talked about in the past is Tao of Capital. It's a great book. It's about libertarian philosophy, Austrian School of Economics, and then also how he goes roundabout with his options trading strategy from Mark Spiztnagel. Are there any other books where you learned how to do this specifically, though?
So I would say my top 4 books for this kind of topic would be Anti-Fragile by Nassim Taleb. Then the second would be Fooled by Randomness by Taleb. Then A Fractal View of the Market, also known as The Misbehavior of Markets by Benoit Mandelbrot. And then Tao of Capital is good. You already said that. That's also a must read in my opinion, especially the later chapters, the second half of the book where he really goes into the roundabout strategy. First half is all Austrian stuff. But if you don't know that stuff, it's important to know. But I think another great book just on what really influenced me, I would say Capital Returns by Edward Chancellor, which is basically the capital cycle. I think that's really important for understanding commodities or flows in a sector, and like asset growth, and like, you know, when's the best time to position yourself in a more micro-based sector. So like when I want to go long uranium or short oil, etc. Being able to understand when to do that, then using the strategies of options I learned from Taleb, I think that makes a really great combination.
Thank you for that. I'm sure my listeners will be very appreciative. Also, Diego Padilla, who has done interviews in the past with Real Vision TV for Anti-Bubble. So he was known as that, but this year he is the top performing hedge fund manager. He did an interview with Hedgeye, an excellent interview in the last couple of weeks. And he uses a very similar option strategy to what you've been talking about for the last 15 or 20 minutes.
Yeah, no, I saw that video. It's free for anybody interested. You could go watch it on Hedgeye. I think they published it a week ago. But yeah, he's a little known guy. I mean, he was little known until recently, but out of Spain. And he uses long dated options because he understands the margin of safety he gets from them. Like, you know, you're paying a low premium on the chance of a play working out. So even if you're wrong, even if you make 10 plays and 8 of them are wrong, those 2 that do work, the gains from those 2 can overwhelm the losses. I'm not saying that happens every single time, obviously, but over a long-term compounded growth rate, I think Spitznagel's proven if you do it correctly and if you're positioned right and the right event happens, you know, you can significantly outperform the market.
Yeah, and he's predicting a lot higher gold prices in the next couple of years. He said $3,000 to $5,000 per ounce gold prices in the next couple of years. And then he's predicting a lot more inflation and bailouts and other economic problems in the Chinese economy too. So let's transition now, Adam.
He has a really good views.
Yeah, it's a great interview. Highly recommend listening to it. I'll put it at the end of this, the link to it at the end of this interview. So Adam, now I want to transition to uranium. A year ago, we were talking about uranium. It was hated still. When we were doing this interview, let me just pull up the uranium spot price. The uranium spot price on February 29th was still at $24.80. It has rallied strongly with mine closures now, even more mine closures, up to $33.94. So from $24.80 on February 29th to $33.93 on May 31st. So a big, big gain in not too long of a time frame.
Yeah, uranium was actually one of the best performing commodities in Q1 and year to date so far, actually next to silver.
So what do you think is driving uranium then? Is it just the mine closures, or is there actually like more demand for uranium with more nuclear power plants being built?
In my opinion, I think it's strictly the supply side. And that's going back to Edward Chancellor's work on the capital cycle. I started going long uranium end of 2019. And not, you know, a lot of uranium investors get really, you know, it's also known as the widowmaker trade at this point, just because so many investors have been burned on it for the last like decade, you know, because a lot of, you know, scrupulous newsletter writers and stuff promise insane returns right around the corner, but then it doesn't happen. And in my opinion, it never happened because a lot of investors weren't looking at the supply side. To put it in context, even after Fukushima happened, where a lot of demand in 2011, when the Fukushima crisis happened and Japan turned off their reactors, a lot of excess demand flooded the market. And at the same time, a lot of new uranium mines were coming online. So you had if you ever look at the global uranium production, up until 2016, it went up every single year, even at a time where you had excess demand flooding the market from extra supplies that weren't being used from Japan's turn off reactors. So going off of the capital cycle, I don't know how on the margin anyone thought higher prices were going to tip their scale, that you would see higher prices in uranium. It was clearly going to go down while you had record new supplies coming online at the same time of all this extra demand, flooding the market, excess demand that's not being used. So finally in 2018, we saw a year-over-year drop in uranium production. Finally, these firms were throwing in the towel. And a lot of people, same thing they don't realize as when the price of a commodity drops, these firms take out a lot of debt. And we talked about this last time, but a lot of these firms, they get stuck in like the prisoner's dilemma, where they're like, even if the supply is becoming a problem and they say, hey, if we stop mining the supply, the prices will go up. They can't afford to stop, because if they stop, they're not going to be able to make cash flow to pay their debt back. So that's a big problem in the oil market right now. And the lower the price goes, the more you have to mine to make up on that same revenue. So if you're at $60 a uranium pound and it goes down to 30, you now have to do 2 times more of the supply just to break even the exact same revenue. So that's what was happening in uranium for years. You saw a huge glut of the supply coming on. And then in 2018, finally, a lot of marginal players, Gazprom, the largest Kazakhstan producer in the world, makes up like 30 or 40% of global production. They threw in the towel and they said, you know what, we're going to cut back like 20%, and then, or like 10%. And then the next year they did another 20%. So all of a sudden, and then Cameco, the world's North America's largest uranium producer in Canada, they shut off their one of their largest uranium producing mines as well. So now all of a sudden you actually had the year-over-year uranium supply declining. And it's actually the year-over-year supply of uranium is back to where it was now in 2010. So it's already back now down where it was a decade ago. While in the meantime, you're having demand pick up. You're even having, because of the low prices, you're even having uranium producing firms. They're actually buying uranium on the market instead of producing the uranium because it's cheaper. Like Cameco's actually been physically buying excess demand on the market because it's been cheaper than them actually mining it.
Yeah, they're a hedge fund. They're almost a hedge fund now, yeah.
Exactly. And so in 2019, when I saw the capital cycle turn, I thought, hey, this is a good time to start making my 1-year call option bets on uranium, especially because it was so hated. It was so low. You could get these options for dirt cheap. So if it didn't work out, no blood loss. Let's say you buy a $1,000 position at the beginning of the year. Now, and you do a 1-year option, December 2019 to December 2020. You do a $1,000 position. That's a little less than $100 on a burn rate. It's like $90 a month, $95 a month or whatever. Personally, that wouldn't hurt me. Losing $95 a month wouldn't hurt me. But the upside, so if it went wrong. But if uranium rallied, you can make 5, 10, 20x returns. Who knows? So that 1,000 could go up to 5,000, 10,000, 20,000. And I did the same strategy in 2016 with gold miners in December 2016, 15 actually, sorry, December 2015, going into the 2016 year, I did the same thing. And I made like 20x on certain gold stocks. And it's not like I put a ton of money, I only did like a couple $100 in each of these plays. But the point is, the risk is so small compared to the potential upside. And the thing that's great about the market compared to like lotteries is that the prices actually change frequently, unlike like a lottery machine with like a fixed rate of return. So it's nice when you can really find the cyclical behavior of a market using capital cycle theory. I think there's like a kind of beautiful not machinery, but like a beautiful rhythm of how it works together. You just understand the capital cycle, and you can use a great strategy, thanks to like, Benoit and Mandelbrot and, Taleb and Padilla, and you use these options, lock in a year's worth of potential upside. You're locking in that upside insurance, what I like to call a positive tail risk. And then if it hits, it hits. And you make a very large, welcoming gain, and then you look for the next place to do it. So I guess that's just how I've been using uranium. I think that the supply, sorry, I went off on a tangent on that, but the point I was getting at is I think the uranium supply side, especially with the mine closures in 2020 because of COVID, it was already in a declining divestment period, the cycle. Now it's only amplified because of the COVID breakout, where you're seeing bigger mine closures happen. So I think that's what's been really pushing the uranium price higher.
How much upside do you think companies like Cameco still have? Would you be, this is hypothetical, whereas if there was another stock market crash and Cameco shares, let's say they went back down again on the charts here, they got as low as $5.50 on March 18th. If it gets back down there, are you going to be looking to get long more options again? You're just going to be accumulating more long exposure, outdated call exposure, like leaps, I guess, if on weaknesses, if there is a dip in uranium and the quality uranium plays?
Yeah, if the risk reward profile makes sense, absolutely. I think uranium is setting up. I mean, we see it happen in other, like for instance, palladium. You and I were talking about before the show. Palladium hit a record high recently, but for years it was at its lowest. It was almost at its lowest price point. It was in a total bear market in 2015, 16, and 17 or whatever, and then it exploded. Now it's at a record high. So same with the uranium. It's going to have these ebbs and flows. And if there's an opportunity, like another big sell-off in the market, like in March 2020, when prices just like everywhere were sold off, and the risk reward profile made sense on the options, and I can get the time I want, like a year, or et cetera, whatever I'm looking for, I would definitely buy more.
Last question on this, since we've been going for over an hour, is like when to take profits. So people are always asking me if they have a winning trade, if the stock they have is doubled, and you have big gains in some of these options trades, when do you think about taking profits?
Say I'm a cold-blooded speculator. Like I would rather risk, like to me, 200-300% isn't really worth it to me. I'm not trying to sound conceited on there, but I just think with some of these plays, I don't want to sell my upside. Last year, I wrote a piece on PCG, the power company in California that caused all those fires. I was able to buy these puts for a quarter each, 8-month puts that were way out of the money. The stock was at 20, and I bought the $4 puts. The stock ended up crashing through lawsuits. Just high flyer. I barely put anything in it. Ended up selling it on, and it was a free play on my website. Speculators made 1,200%. Right there is like 10 years worth of gains for most investors off of one crazy like little Hail Mary that if it didn't work out, it didn't even matter. So that to me is what I'm looking for. I personally don't like to sell for less than 500%. Like I will, if it makes sense, but when you lock in, when you have room to run and options have a directional play. So when, for instance, like Cameco, when it's in a directional uptrend, and the momentum's with it, like silver and gold have been. I just don't see why selling for 200% would really make sense. Now, if I was like crunched for time, or if it was a short-term play, maybe. But of course, everybody should always do what they're feel comfortable with. But me personally, I like to hold these things, until I pretty much can squeeze as much upside as I can.
Everyone is different with their investing and trading methodology, because the higher a position goes, it might be a larger and larger stake of your investing or trading portfolio. And some people might not be able to sleep with it, might not be able to fall asleep at night. So if you have a large chunk of your portfolio in one trade and you're up enormously and you haven't pulled any profits off the table and you can't sleep, you need to re-examine your position sizing.
Absolutely. Yeah. You should always do what makes you sleep well at night. And that's why I like the option strategy we've been talking about, the positive tail risk or the anti-fragile plays. I like, optionality plays. I like to call them positively asymmetric, low risk, high return, because if I wake up, let's say I made a play on uranium and it didn't work out and it goes to zero, I'm like, oh, okay, all I lost was that premium. No more, no less. It's not going to ruin me. It's like a little paper cut. It's not going to blow, I'm not going to blow up. It's not going to ruin my entire portfolio because I already put the money into the insurance. But then let's say a month later, something happens in the uranium market, like what happened, COVID, mine shutdown happened. All of a sudden the uranium price hit like a 4-year high. You wake up and you see that and you're like, oh, awesome. Up this, 300-400%, year to date. And that to me makes me sleep better at night. And I think a lot of investors, when you're able to know your total downside, that's why I like the optionality. You can see the total downside. Like you're like, okay, I can only lose this in premiums. Whereas if you sell options, I mean, your risk can go infinite. It can go as high as it wants. That's selling naked options. That's why most of these hedge funds, the thing they always have in common is they usually sell naked options, because it's a quick way to make a buck at the end of a quarter when you need to, pad your fund or make your returns look better. But then you're on the hook for the entire duration of that option contract, that if something goes wrong, you could blow up instantly. Like as we saw James Cordier at Option Sellers,
or AIG.
Victor Niederhofer.
AIG sold all that credit default swap and they didn't have any cash reserved for it.
Yeah, perfect example. So yeah, there's tons of examples. And that's, I think fundamentally my philosophy on investing is always like, you just want to make sure your downside is knowable, fixed, capped, and your upside can run. Your upside has unlimited potential. That's where I think you want to position everything. Not situations like AIG where you do something where you make a little bit of money, but your downside is potentially unlimited, a bottomless pit.
Yeah,
and
collapsing the entire financial system and all their counterparties.
Exactly. Yeah. So I just, I think investors need to learn. I mean, I hope they have more of an interest. And I know a lot of people get turned off by options because it comes off as complicated, but if I can learn it, I'm sure many other people can learn it. It's not like I'm a crazy smart guy, but I mean, you just look at it in the terms of it's insurance, and how you would buy health insurance or car insurance. If you don't use it, you waste the premium, but God forbid if something happens and you need that insurance and a big bill hits, you're covered. That's the same way to look at it.
Yeah, it's volatility insurance, what Christopher Cole said, and you don't even need to have a large percentage of your portfolio. And I think Christopher Cole recommended about 20% total with gold and volatility and options trading. So you don't have to put, if you're not comfortable with it, you don't have to put a large chunk of your portfolio in it, and it's more of like a defensive strategy or hedging strategy.
Absolutely. Yeah, like absolutely. Like I used the uranium play I did, I put in 2% of my investable capital in that play. So if it didn't work out, I only lose 2% of my max portfolio, no more, no less. Whereas if I would have sold options with 2%, where it could have ended up eating up 98% of my portfolio if it went wrong. So, like you said, just using a small amount, using a barbell strategy where you kind of focus on the tail ends of everything, really, really safe. And then the other side, really speculative. On the really safe side, you could put 98% of your portfolio in bonds, cash, physical gold, whatever you want. And then the other 2% speculative money. For example, you could, use that 2% to put into various little plays, because then that 2% could end up, if it nets 10%, then you can make, 20% of your portfolio in gains off of just that 2%.
Well, Adam, you've given my listeners a lot to think about today. There's a lot of book recommendations, a lot of analysis there about hedging and volatility and options trading strategies, a lot of good macro analysis I have not heard anywhere else too. You are a wealth of information for being under 30 years old. I want to thank you again for your time. My listeners want to follow you on Twitter and also take a look at your research behind the Speculators Anonymous website. How did they do so?
Yeah, so you could just find me on Twitter at Radical Adam, at Radical then Adam, that's ADEM. And my website, speculatorsanonymous.com, just how it sounds. I've been focusing on a lot of the premium stuff and for the last couple months, but I'm back to posting free content on my site. But, if you're interested in my premium content, just click the premium tab and, just see some of my past returns and plays. And you can also check them on my website. Go to the tab that says under articles, potential plays, and any article at the bottom, I disclose a play that I've done, and you can look it up for yourself.
Okay, great. Well, thank you so much for your time. I really appreciate it. I think my listeners are going to get a lot of good information and analysis out of this interview.
Yeah, as always, thanks, Jason. And just before sign off, on that topic we were talking about, another book I think everybody should read with history and macro would be that book, The Great Wave by Jeffrey Hackett Fisher. That was the book I was telling you about, the price revolutions, the great waves of inflation and deflation for the last 1,000 years. It's a big book, but it's really easy read. And that's been one of the most important books I've read in finance. And it's super underrated. So I highly recommend it.
I'm sure my listeners will appreciate that.
Great. Okay. Thanks, man. I appreciate it.